Good afternoon, everybody. Welcome back to the Opportunistic Trader. It's just about noon on December 21st, and we are joined now by Coquest advisors Marc, Lorin, and Ryan Hart. Marc specifically has joined us a few times talking about the CTA world and different opportunities and things that they're seeing in that space. These guys both have a lot of experience in Coquest as a whole, a lot of experience working with CTAs, and we'll get into more of that as we're speaking. So, Marc, Ryan, welcome. How's it going?
Hi, Mike. It's going well. Thank you for having us participate in this webinar. As usual, we enjoy sharing our experience in the markets with you.
Absolutely. So tell me, here we are, end of December. It's been a wild year. February was It's been a volatile year. Tell me what has been interesting. What's caught your eye, and tell me about the CTA space, how they fared.
Well, we have seen a difficult and disappointing performance in 2018 for CTAs. It's been a roller coaster ride. Starting with January, it started with a bang when many managers had a top 10 best month, really, and putting broad CTA indices close to the high watermark. But their fortune quickly reversed in February with the volatility tantrum sharp whipsaw, causing many managers to have a bottom 10 worst month. So one after the other, really, top 10 best and then top 10 worst. And while August was a very good month, May and October were not. So where do we sit right now as the year draws to a close? Well, our own Coquest 40 index, which is an index of the largest 40 trading programs by assets in managed futures, was down about 4.7% through November. As well, most sub indices are down, with trend following leading the way, close to down double digits. Short-term traders and micro traders are faring better, around flat for the year, especially discretionary micro traders, which are slightly positive. Actually, overall, discretionary traders, slightly up for the year, are doing much better than their systematic counterparts, which are down about mid-single digits. The only bright sector is really volatility traders, which are up over 4%, capitalizing on the renewed market volatility we've been seeing this year. Which is ironic when actually many premium harvesting volatility managers went bust in February. With regards to the markets offering opportunities in 2018, the most challenging ones were bonds and currencies, and to some degree equities because of the recent sharp reversals. But this was somewhat offset by commodities, especially energies, which were positive contributors year to date, and of course crude oil, which is having a nice downtrend recently. So what did I say that the year was disappointing? Well, besides the negative performance for CTAs in general, the disappointment really comes from the fact that performance in February and October was negative when equities were down sharply during these 2 months. Because of their positive convexity, CTAs, especially trend followers, typically provide risk mitigation or that so-called crisis alpha during periods of negative performance in equities. And we haven't seen that happen this go around, which was a disappointment. Why is that? Well, the sell-off in equities in these 2 months were so sudden that the systematic strategies did not have the time to adapt and turn around their generally long equity beta portfolios. So they ended up generating negative performance then. Also, CTAs thrive in high volatility environments, but do not necessarily manage well during changes of volatility regime. So while disappointing, this poor showing of performance is not surprising when we move from a record low to a more normal volatility environment.
Marc, just to interrupt there, tell me more about that, because somebody who would hear that would say, we have VIX of 27, we have crude oil that just dropped $30. This is volatility. This is when they should outperform. So take me through what the difference of high volatility and the change, like you were saying, the change in volatility where they're underperforming because of it.
Right, Ryan, you want to take that one?
Sure. This is Ryan Hart. Yeah, what happens is high volatility and elevated volatility tends to be good for trend followers and other CTA strategies. And, bigger picture, I think we're setting up for a good environment in 2019. But transitions can be challenging, especially when they're accompanied by trend reversals. So if you look at the most negative contributor to performance for CTAs in general, but more specifically trend followers, which kind of dominate the indices. If you think about the environment we are coming out of, we've had extremely low volatility coming into 2018. and very strong trends in equities, particularly during January, which Marc mentioned. Was we were almost parabolic there, and CTAs had a very strong month. So what we saw was that these trend followers were building large positions in equities. Most of them use volatility as a measure of risk and use that as the denominator as a way to size their positions. You're getting stronger trends. Low vol means you're going to have a bigger, juicier position in those markets. Then what we see is the spike in volatility accompanied by the reversal in early February, and those markets just fell out of bed, really hammering those trend followers that had those positions on. At that point, they start to reduce those position sizes, but that move was so quick that pretty much all the damage was done within a matter of days. So now they've got smaller position sizes on. And if you recall, starting kind of, the beginning of, let's call it the beginning of April, we got to bounce back it through February and March and then kind of reversal again. But through April, we go back in and just rally through kind of early October in equity markets. So these trend followers start building those positions on the long side again. And volatility, kind of, it was higher than it was, but starts to decline again. And then we get to October. Similar thing happens. Most of the damage is done early on in the month, a matter of days. And, these trend followers take these big losses because, again, we've had relatively low or modest volatility heading into it. And that, again, was one of the stronger trends in the market outside of perhaps short oil, short crude trades at that point. Now, what we've seen since is interesting. And I think what makes, trend followers at least feeling good about how things are setting up heading into 2019, and what we've seen, the latter part of November and here early in December, is their positions now are much more balanced. So what we've seen is trend followers have been making money on days when the S&P is up. They've been making money on days when the S&P is down. I would say because of the volatility we've seen, even if they were still long, if you're a really long-term trend follower, you might still hold a small long position. But because volatility has spiked, they've reduced those position sizes. Most trend followers in the medium term space have flipped to being slightly short. But again, these are smaller position sizes due to elevated volatility. And we're seeing other trends now in other markets that are strong enough to kind of have a balanced risk exposure across those books. So while those transitory positions or transitory periods and volatility can be challenging, we now seem to be in a period of heightened volatility. And, now with a more balanced portfolio, if vol stays high, we would expect this to look more similar to periods where you've seen trend followers do quite well exiting the initial stages of a reversal. So if this turns into a true bear market, I think trend followers will generate the type of performance that you've historically seen. If we come rallying right back out of this thing, it's going to be tough for them.
Right, and I would add the other ingredient for CTAs to make money is a breakdown of correlation across markets, in the sense that usually in an environment, in a fairly quiet environment, markets have a tendency to correlate a lot with each other, and then when you get into a bit more of a mess, these correlations break down. And that's when CTAs have a tendency to do better, because CTAs basically spread their risk across many, many markets. So when all the markets trade as one, they really can't spread their risk. It all becomes one trade. Whereas when the markets, the correlations break down, they have more of an opportunity to capitalize on making money here and there. CTAs try to basically risk 1 to make 10. So they have a bunch of small losers, but then they have these outside gains on the one trade. Well, if the market correlations break down, then they have more of an opportunity to take less small losses and can capitalize on these big wins.
Yeah, that makes sense. So take me through specifically, while we look back at 2018, crude oil has been an unbelievable move. From summertime, we rallied from the mid-60s level up till October. We got above 77, and now here we are right now at 45.75. Take me through the different strategies and how they handled it and traded that. and performed in that?
This is Ryan again. Trend followers, I would say, were hurt at the beginning of October in that trade. Again, we were kind of coming out. The trend there exposures weren't as large as they were in equities at that point. But we had a decent rally heading into that flip. That was one of the things that hurt trend followers so badly in October, is that there was really not a lot of places to hide in their portfolios. Now they've made a lot of money since then, because that trend has been significantly to the downside, and almost the opposite of what we saw in equities in January, where it's just fallen out of bed. So that's been quite good for a lot of those traders. And I think what's been more interesting in the energy space is, we've talked a lot about the trend followers. What's been interesting in that space is that the fundamental traders have actually navigated this quite well throughout the year. I would say we've seen a lot of discretionary traders, especially those who are trading multiple markets, and doing a lot of the spreads, have navigated this extremely well. Now their performance, we're not talking about blockbuster performance where these guys are up like 20% or so, but they have had relatively low vol this year. And been able to kind of squeeze returns out of some of these spreads throughout the year. I would say that the more recent part of this move has actually been challenging for those discretionary traders, because I think many of them have started to think, hey, this can't go any lower. Now it's starting to look like a value buy. And some of them have transitioned their portfolios to have a longer bias in energy. So it's been interesting that the discretionary traders who performed well in energy kind of throughout the year have now been struggling, like let's call it this last, the couple weeks to a month, while it's been almost the exact opposite for the trend followers.
Yeah, that's interesting. Then shifting ahead to 2019, like we said, we've had significant volatility in the equity and energy arena, whereas actually in the dollar space, FX has actually been really quiet. Volatility is near lows for the past few years, which is pretty interesting itself. Fixed income's been pretty volatile, where we've seen, let's say even the 10-year move from the 3% level to 325, then back to 280-ish. What are we looking at for Q1 of 2019?
Well, low volatility across all markets has been a challenge for CTA since the end of the financial crisis. So going forward, a more normal volatility environment should benefit all CTA strategies. And then because of the anticipatory nature, discretionary macro traders should have plenty of opportunities to distinguish themselves as global capital flow patterns start to change. So I would expect currency traders to also capitalize from these changes in capital flow patterns. And then, of course, trend followers may be presented with an opportunity for outsized gains, like Ryan mentioned earlier, if the recent trends continue, meaning equity markets continue to be challenged and the recession profiled itself on the horizon for 2020 or 2021. Overall, certainly I would expect an improvement in performance. I mean, I believe this higher volatility environment is here to stay due to higher economic uncertainty, like the global economic slowdown we're seeing, the tariffs, the trade war, uncertainty in various geopolitical areas, and the recent sell-off in equity markets. So that's my view.
What about on the asset flow? This year it went, and now we're near the end. It's a negative year for a lot of different strategies, almost every strategy. And I'm talking equity. I'm not just talking CTA world. I'm talking a lot of asset classes, a lot of asset structures. So how has that affected AUM, and what's the thought process for AUM in 2019?
Well, AUM and CTAs, when you look at it, has grown slightly in the last few years. It's sitting around, call it $320 billion or something of the sort. But what the underlying current really has been that the assets have gone to the largest of the managers. And actually, I would say that the smaller managers their assets have shrunk since the financial crisis overall. But I think going forward, what's been interesting is that you're seeing a lot more interesting strategies being managed by smaller managers, which allow you to diversify a portfolio of CTAs to a much greater extent than selecting the 10 largest programs. So I think going forward, as the market, the volatility starts to go up, all CTAs will be presented with a better environment, but I think the smaller managers will be more nimble at being able to navigate this environment.
But are you seeing anything at this point? Like we've only seen some volatility here for a few weeks now, so I wouldn't expect the liquidity to start pouring out yet. But anything where you're seeing people redeeming, moving to safer assets, moving to cash, just because CTAs aren't performing well, equities aren't performing well, things of that nature?
I would say we haven't seen that yet, but granted, we're really only a month after folks would have gotten their statements. So I would say what we've seen is actually some renewed interest in the space, because folks were getting hurt elsewhere in their portfolio. And I think that, people that, at least our client base, they're used to looking at CTAs and having kind of through the more volatile environments where you've had some big drawdowns, and a lot of them like to buy the dip. They know that the transition periods can be tough. So we've seen some of them, increasing their allocations now that volatility has spiked. Now, I think some of the newer folks in the space and where some of the asset growth has been, we're probably going to see some big redemptions, perhaps on the mutual fund side of things. One of the things that Marc touched on that I think is kind of driving some of the market moves we've seen is the asset flows into CTAs, which, as Marc mentioned, the space has grown despite what's been kind of subpar performance for a number of years. But most of those assets have gone to, as Marc mentioned, either the largest managers, the big trend followers. But we've also seen a lot of the assets go into strategies that perhaps maybe we wouldn't have thought of as CTAs in the past. So I'm talking about some systematic macro and risk premia strategies that a lot of pensions and endowments are allocating billions of dollars to. And many of these strategies that they're allocating to are really kind of, long biased risk premia capture strategies where they might use a risk premia approach, or I'm sorry, a risk parity approach, or just kind of vol-based sizing on their positions. But these are long bias strategies. So as these guys were trying to capture, various kind of risk premia like growth or just equity risk premia or various carry strategies, the way that they're sizing these things as vol spikes, it's almost like what we saw in '87 with the risk, the portfolio insurance. It forces them to shrink these position sizes, and this is happening at the same time that these large trend followers now are seeing these reversals and volatility spiking, so they're reducing their position sizes or flipping short, and all this selling is happening so quickly. I think that's why you're seeing these sharp moves downward in the markets. That's really the two spaces we've seen the most asset growth in the space. And this is happening not just in CTA land, but also across ETFs that a lot of these pensions and endowments are allocating to in these strategies that don't get captured in the CTA asset space. So I think some of the mutual funds following those strategies, as well as some of these larger managers that pensions and endowments have allocated to and who are perhaps newer to these strategies, we could see some redemptions there, which could even exacerbate some of these moves in the near to medium term.
Interesting. So you guys have something called the CTA challenge, where you keep track of a few hundred CTAs. I think you said over 50 participated last year, where they basically are tracked from their brokerage statement. They can see exposure, P&L, and rank versus, how well people are doing versus the cash they used, a lot of different risk metrics. It's getting close to 2019. Tell me more about the CTA challenge.
The CTA challenge had or has about 35 participants for 2018. For 2019, we decided to change things a bit because we want the challenge to become much more representative of the industry. I mean, overall, there are well over 1,000 trading programs in the CTA industry. So we want to try to capture a broader subset of these programs. And so, whereas the managers had to pay to enter the challenge, which for them they were okay with paying a fee to enter the challenge because there was a lot of publicity, especially for the guys that make the top 10, and the ranking is published about 24 times a year through a newsletter that goes to investors. But for this coming year, we decided to actually waive the entry fee and try to draw more programs. So we're hoping we're going to get a lot more programs in the challenge.
Nice. And so you can register. I'll put a link in the website. If you can send it to me, I'll put a link in the website so people can check it out. And when do they have to register by to be registered for 2019?
Registration is happening right now. Actually, the challenge runs from January 1st to December 31st, and it is a risk adjusted performance challenge. And to gauge the risk, we actually look at actual measures of risks taken, not the risk realized like volatility or downside deviation or drawdowns. So we actually have to track an account that the CTA is trading, and so we need to make that happen before the end of the year, so that on January 1st we start tracking the account.
So for 2018, you don't have to say the fund's names or firm name, but what the top 2 or 3? What performance are they up on the year? Ballpark. I know it's fluid, so but ballpark, where are they year?
I haven't looked in a bit, but I can quickly look. I can tell you that out of the top 3, 2 of them were meat or protein strategies.
Explain what a protein strategy means.
They trade cattle or livestock or live cattle, hogs, or any.
Interesting. So in a way,
farming.
Looking at that, the crazy markets that we've seen in the more major markets that we've seen, some of the outperformers are finding their edge in a less liquid market that they know well.
Right. So the top CTA in the program is up 22.43% year to date.
Bad. Okay. All right. Well, did you guys have anything else to add? Thoughts for 2019, or any last points you wanted to get in there?
This is Ryan. I think, one big thing I would say is that, it seems like 2018 has been kind of a period of transition, and we'll get to be seen if this market is going to roll over more. I mean, it's rare that you see a sell-off of this magnitude without some sort of catalyst. We haven't seen, any sort of, credit catalyst or anything like that yet. Although I guess you could argue there's been a lot of headwinds and concern that perhaps has been the catalyst. But it's rare to get this kind of pullback without some real event. If we see an event, and this thing continues more to the downside, I think that the trend followers will capture that. If this comes roaring back out, I think 2019 is going to be another year of underperformance for them. In terms of the other strategies, the heightened volatility that we've seen, if this remains, and we believe it will, it sort of corresponds with what I would call, quantitative tightening, and the removal of a lot of these, the backstop that central banks have had in place. If this volatility remains in place, I think that discretionary traders and, some of the more short-term pattern recognition type CTA strategies will probably have a much improved environment than we've seen for a number of years for these guys. I think trend following is really going to turn on whether or not we get some continuation out of this, or if, we just come roaring back out.
Interesting. Well, very interesting market, very interesting year, 2018. You guys see it up close. But thank you very much for joining us. This is Coquest Advisors. And I'm going to put in the chat room more information about the CTA challenge, so everybody can take a look. But Ryan Hart, Marc, Lorin of Coquest Advisors, thanks for joining us.
Thank you.
Thank you, Mike, for having us.